This week we study chapters 3 and 4 of the textbook. Chapter 3 introduces the double entry accounting system. In order to actually accurately capture the vast number of financial transactions that a business engages in each year, a system was introduced over 500 years ago. This is what we call the double entry system. It is somewhat like the traffic laws that keep cars flowing and people flowing in Los Angeles. Red means stop, green means go, and so on. In our analogy, these would be debits and credits. We begin with the accounts. An account is an individual record of increases and decreases in a specific asset, liability, or equity item. We saw the list of accounts used in the balance sheet report in Chapter 2 on page 75. This is a good place to start by looking at accounts. Note that there are three classes of accounts: assets, liabilities, and equities. For teaching purposes, we display these as T accounts. They're called that because they resemble the letter T. In actual practice, these accounts are managed by computers and no longer take physical form until it is time to report the account balances. The terms debit and credit refer to the left side and right side, respectively, of each T account. The fundamental accounting equation guides us when recording increases and decreases in the account using debits and credits. For all asset accounts, a debit entry represents an increase, while a credit shows a decrease in that account. Both liabilities and equities are exactly the opposite, with credit entries showing increases and debit showing decreases in these records. Asset transactions are categorized as either source transactions, exchange and use transactions. The text gives several examples of each. Note that every transaction involves two or more accounts. One account is debited, the other is credited. We call this system double entry bookkeeping. Note that each transaction is presented in horizontal format that emphasizes the accounting equation, which is generally listed right above. This is to help you understand the effects of each type of transaction on the financial reports. The process of generating data to be entered into the account begins with source documents. These include things like sales receipts, invoices, checks, time cards, deposit tickets, and so on. Every transaction must begin with and be backed up by a source document. These are stored until they can be legally shredded, generally for a period of 2 or more years, as dictated by the IRS. Each transaction is recorded in a journal, which is called the Book of Original Entry. This allows for the accountant to track every transaction chronologically. The increases and decreases for each of these transactions is then transferred to the separate accounts. The collection of all accounts is referred to as the ledger of accounts and is therefore called the Book of Final Entry. The process of transferring the data as debits and credits from the journals to the ledger is called posting. When this is done, a systematic cross-reference is also recorded so that each account entry can be traced to a journal record of the transaction, which can then be supported by a source document. This allows auditors to check the accuracy and reliability of the financial reports based on the accounting records of a business. The trial balance is a tool for checking the accuracy of the accounting record. It is based on the fact that total debits and credits recorded in the ledger of accounts should equal or balance, hence the term balancing the books. At the end of each accounting period, at least once a year, the accountant closes the temporary accounts by transferring their balances to permanent accounts using closing entries. The final balances are recorded in the financial reports. A trial balance is performed and the cycle begins anew. Finally, the authors introduced the subject of financial analysis by showing how accounting records and reports can be used to judge the financial health of a business. The purpose of Chapter 3 It is to give you a conceptual overview of the recording and reporting process. The actual bookkeeping now is done by computers. The work was once done by hand and involved much more clerical labor than it takes today. We turn to Chapter 4, which shows accounting for the merchandising business. These are commonly called either retail or wholesale businesses. A key feature of this type of business involves accounting for its inventory. Take note of the learning objectives found for the chapter on page 188. We start our discussion with the perpetual inventory system. Later we will introduce some alternatives to this, but for now it is the ideal system for introduction. Our goal is to accurately measure the cost of goods sold. The difference between revenue from sales of inventory and cost of goods sold is called gross margin or gross profit. We then subtract selling and administrative costs from this figure to find taxable income. After paying taxes, we are left with net profit. The goal of every business is to make this final number as large as possible. Economists call this activity profit maximization. The balance of the chapter details transactions affecting inventories and sales and their effects on the income statement and balance sheet reports. We will try to do some of those discussion question problems that are assigned at the end of the chapter during class time so that you get a notion of how to approach them. And I look forward to seeing you in class this coming week. It should be a great time. See you later.